So, what if a billionaire hedge fund manager just dropped a plan? A really bold, really controversial plan to fix one of the biggest messes left over from the 2008 financial crisis. Yeah, we're talking about a problem that sits right at the heart of the US housing market. Okay, let's get into this high stakes game. It all boils down to this one massive question. How in the world do you fix Fannie Mae and Freddie Mac? I mean, these two companies are absolutely essential for American homeownership. They have a hand in pretty much every mortgage out there. But they've been stuck in this government-controlled limbo for what, over a decade now? This isn't some small issue, it's a giant, trillion-dollar headache that has had policymakers totally stumped for years. All right, so to really get a handle on the proposed solution, you first have to understand the problem itself. And it really all comes down to one key word that has defined these companies since the crash. And that word is conservatorship. You can basically think of it as a financial life support system. Back in '08, the housing market was about to go over a cliff, so the government stepped in, took control of Fannie and Freddie, and said, okay, we're running the show now. And guess what? They've been running the show ever since. Now, to keep them from completely collapsing, the U.S. Treasury had to pump in a ton of cash. And the official number they still owe from that bailout is a jaw-dropping $193 billion. That number right there is the massive anchor that's been weighing this whole situation down. But now, stepping into the ring is Bill Ackman, the founder of Pershing Square Capital Management. He's a huge investor in these companies, and he's not just sitting on the sidelines. He is proposing a seriously audacious plan to finally break this deadlock. And this right here, this is the core of Ackman's entire argument. He points out that, Fannie and Freddie officially owe $193 billion from the bailout, but, and this is a huge but, they have already paid the Treasury more than $310 billion in profits. So from where he's sitting, he's saying, look, the debt has been paid back and then some. So with that logic, his plan is actually, refreshingly simple. Step one, the Treasury just forgives that $19.3 billion debt, wipes it clean. Step two, the Treasury then uses its existing warrants to buy up nearly 80% of the company's stock. And finally, step three, you relist these now much healthier companies back on the stock market, unlocking all that value. Simple, right? So you might be asking, why push for this right now? Well, because Ackman and other investors see a giant red flag on the horizon, a huge risk that could literally wipe out their entire investment overnight. Here's the nightmare scenario for investors. The big fear is that the Treasury could just decide to play its ultimate trump card. They could convert their special bailout shares into regular old common stock. If that happens, it would unleash a flood of new shares onto the market, which would massively, and I mean massively, dilute the value for every other shareholder out there, including Bill Ackman. And listen, this isn't just some far-fetched worry. A recent report from Deutsche Bank actually put a 20% probability on this exact thing happening. That's a 1 in 5 chance that current investors could see their holdings go up in smoke. And that brings us right to the heart of the debate. On one side, you've got Ackman's vision, a clean slate, debt forgiven, value unlocked for everyone. But on the other side, you have these deep market fears that the government will never just forgive the debt and that this constant threat of dilution makes the whole thing way too risky. Well, as you can probably guess, not everyone is sold on Ackman's big idea. In fact, financial analysts were pretty quick to jump in and point out some major flaws. For instance, analysts over at Keith, Bruyette, and Woods, KBW, they argue that even if the government forgives the debt, and that is a huge if, there's a bigger problem that doesn't go away. The companies still don't know how much money they're required to keep in the bank as a safety net. And that uncertainty about their capital levels, well, it directly messes with how profitable they can be. So let's talk about the bottom line, because that's what matters. In his big presentation, Ackman valued the companies at $387 billion if his plan goes through. But KBW, they ran the numbers, and even if they assume the debt gets forgiven, they come out way lower at $344 billion. That's a $43 billion difference of opinion. That's not chump change. And then you have the folks at Wells Fargo, who had another sharp criticism. They basically said Ackman's plan feels like a short-term patch-up job. It's designed to make the market happy right now, but it completely avoids the really tough structural questions about how we should fix the housing finance system for the long haul. So if we boil down all the skepticism, it looks like this. First, asking the government to just forget about nearly $200 billion is a monumental ask. Second, the plan totally sidesteps real long-term reform. Third, it kind of seems to favor the current investors by making sure the government's safety net stays in place. And finally, at the end of the day, any real change depends entirely on which way the political winds are blowing. So, where does all of this leave us? I mean, what does this whole intense debate really mean for the future of Fannie and Freddie and, for anyone out there who has a mortgage or ever hopes to get one? While the big takeaway seems to be a real shift in thinking, this plan and the whole conversation around it shows that there's a growing appetite for just getting some stability right now. The idea is let these companies get healthier, let them build up their cash reserves, and then let some future administration deal with the really thorny, messy questions about long-term reform. Which leaves us with the ultimate question, doesn't it? Is Bill Ackman's plan a genuinely smart and pragmatic first step to finally ending the longest bailout from the financial crisis, or is it just a convenient way to kick a very, very expensive can a little further down the road? The answer to that is going to shape American housing for decades to come.